Well, good morning, everyone. It's good to be here with you. We had a little change in plans. Originally, Paul Kamhut from the CME group was going to lead our panel. And Paul wasn't able to make it, so I'm going to kind of help guide some of the questions. What we're going to do is we're going to be looking at 3 or 4 different areas. One are the energy markets, the second one are currencies and gold, and the third one will be stock indices. I'll cover that one, and Anthony here is going to be covering the energy. Amelia is going to be covering the currency and gold. And what I would like to start with, how about if you just give us a few words about your background and...
Sure. Well, good morning, everybody. Thank you for attending. I'm excited to be here. I just flew in from Florida last night. I'm Amelia Bordow. I'm the owner and founder of Market Compass, LLC. You can find me online at www.marketcompassllc.com. I have 17 years of experience on Wall Street. I left Wall Street a couple years ago to found my company. So I started my career early on in the Asian financial crisis at actually the Federal Reserve Board in Washington, D.C. I was a research analyst there in the international division. Then I moved on to Deutsche Bank for a number of years on the FX trading side there, and also UBS. So at the times that I worked at Deutsche and UBS, they were the world's largest traders of foreign exchange, and both of those were in New York. I also worked at a couple hedge funds as well. In between, I worked at 2 macro hedge funds, one based in Australia and one based here. Lastly, I worked at Unicredit Aga as a trading salesperson there as well. So I'm used to talking to big institutional clients. I understood how they trade, and that's the kind of way that I approach markets from this top-down view.
Great, thank you. Anthony, you want to share some
I'm
your
Anthony.
background?
Yep, I'm Anthony Grisanti. I've been a member of the at the New York Mercantile Exchange since 1990. I've been in the commodities industry since 1984. I started as a clerk and then kind of moved my way up as the years went by. I was primarily based on the trading floor, the NYMEX trading floor. It doesn't exist anymore. I'm in an office. I advise clients, everybody from hedge funds to the daily trader. I trade every day myself and try to help you guys do better with my 35 years experience.
Great, thank you. Well, as everyone knows, we've had an interesting week or last few weeks with information that's been coming out, and that dominant piece that we keep hearing about is the coronavirus and the impact it's had on the market. You know, stock markets hate uncertainty, and we've seen that in the stock market. Commodity markets have a tendency to love uncertainty because it implies potential for shortages. So we're seeing capital flow between these different sectors. It's something that I look at, and that is, I look at stock indexes and currencies and interest rates and metals and energy and agricultural markets, because when money comes out of one sector, it goes someplace else. But I think what's interesting is the impact that we've seen, and it's also interesting what just happened on Friday, how we finished this week out. So how about if we start, Anthony, with you, excuse me, and let's take a look at what's been happening with OPEC Plus and the inability to get certain things done. And
well, it's all about demand right now, and there are a lot of concerns about demand before the coronavirus because of the trade war.
Yeah.
So OPEC and the frackers in the U.S., they were looking at that point, and some estimates had that demand because of the trade war in China was down 1 million barrels a day. Now, because of the coronavirus, I read reports 3 to 4 million barrels a day demand is down in China. So it's no surprise that OPEC said we need to cut production because the price of oil is going to head into the 30s right now, probably into the 20s. And then now you have Russia saying that we're not going to do that. Why should we carry the water for basically the shale producers in the U.S.? And the Saudis, years ago, if you remember, they had this idea, we're going to pump all out and we're going to put these people out of business. It didn't work because the capital kept flowing into the shale space. So they were able to keep holding on, even though a lot of shale producers don't make any money at this point, the capital was still flowing in. I don't think you're going to see that this time. This time the capital, I think, is going to be very tight. Look what's happening with the equities markets right now. So if shale producers start going out of business, eventually, and we're talking probably 6 to 8 months down the road, you could see production in oil drop considerably. I mean, the U.S. right now, 12.5 million barrels a day. Some are saying 11 million barrels a day by the end of this year because of what's happening there. If that starts to happen, that could stabilize the price, could drive it higher, but as you said, there's a lot of uncertainty right now.
There is, and the demand aspect, I think, really is the key here.
That's exactly what it is.
I mean, if you look at China, if you and I are producing a lot of crude oil, we need to have somebody to soak it up. So crude oil, I've really been bearish that market now for probably a few months. I just think there's too much supply compared to the demand we have for that product. But I think what's also interesting in the shale sector is that we've learned, 2008, 2009, a lot of shale producers went out of business because their break-even point was around $40 or $50 a barrel. Now, some people have learned, and our technologies have improved, so some of these producers can go down to like $30 a barrel and still be profitable.
Yeah, mostly in Texas. You could see the production in mid-30s
Permian
right now.
Basin is a good example.
In the Dakotas, it's still very high. So you're going to see those probably be affected first rather than the ones in Texas.
And you know what's also interesting is the challenge if you're an oil producer. Think if you're one of the countries in OPEC and you're going to reduce the amount of production you make. Well, that doesn't prevent the United States from producing more. And so what you're potentially giving up is your piece of the pie. You're giving up your percentage of global supply. So it's a tricky balance. And yeah, it's going to be interesting to see how it unfolds. And what's interesting also is how what Anthony has said, how it bleeds over into our next sector. And that is the currencies. The Canadian dollar we saw weaker, and we also see money flowing towards other currencies. And Amelia, do you want to give us some insights into that?
Sure, of course. So it's very interesting, obviously, the slowdown in China. Even, big think tanks like the Peterson Institute and, all the major banks are trying to forecast the extent to which China has slowed. We know it slowed precipitously. We know auto sales in China dropped 80% in February. Their February PMI was bad. We have to wait to see the GDP results. We know it's going to be very bad. We just don't know the Q1 numbers. We just don't know how bad. And so it's interesting to see how that slowdown in China really affects the other parts of the world. So if we're speaking about oil and the lack of demand for oil, we need to watch the Canadian dollar. Obviously, last week the Federal Reserve did an emergency rate cut of 50 basis points. In Canada, the Bank of Canada followed on to that. They also, a couple days later, cut their rate the same amount, 50 basis points. The Canadian economy is not in bad shape right now. Kind of like the U.S. economy. The U.S. economy, we just had a great payrolls number. It's chugging along. But the risk to Canada is now twofold. The risk to Canada is obviously the drop in the oil prices, and that's going to negatively impact Canadian dollar. And the second risk for Canada is if the U.S. slows down. We're obviously its largest trading partner, and so that would feed into a domestic slowdown in Canada as well. In terms of China-specific slowdown really impacting one country, that's clearly Australia. Over 30% of Australia's exports go to China, and so the Australian dollar has really been hit on this. And another geopolitical event, or another natural disaster, I should say, that took place in Australia. So much has happened between the end of December and right now. It's absolutely incredible. It's almost, do you remember in early January the terrible bushfires that were burning Australia? I mean, to think that that's also happened, and now they have coronavirus, and now they have the slowdown from China. So the Australian dollar has really been hit as China weakens its currency. The Australian dollar is now sitting on very significant, decade-wide support levels, and so that's something to watch. And it also, Canadian dollar is clearly something to watch. While it's been weakening, it could weaken substantially more, should oil be back should go into the 30s and some slowdowns start to occur in U.S. numbers.
How about, let's explore what we've seen in Japanese yen, a currency that we think of as almost as a reserve currency, that when the U.S. dollar sometimes strengthens, money also flows towards the Japanese yen. But that's not what we're seeing now. The dollar's weaker, but our friend Mr. Yen is
Yes.
going up.
Yes. So what happened was, I'm actually doing a presentation at 2:45 today on global macro. We're going to go over this in great detail because it's so fascinating. But if we look at safe havens and asset classes, right, there's a dollar, there's a yen, there's a Swiss franc, and there's gold, okay? And so I normally talk about dollar and yen. Swiss franc, I worked at Swiss Bank, I worked at UBS for a number of years, and the reason I don't trade, we did trade Swiss, it was pegged when it was a managed currency when I was working there. And the reason I don't trade it very much now is because Swiss Bank comes in and they intervene in the currency when Swiss gets too weak against euro. So I'm leaving Swiss out of this conversation. But when coronavirus initially started, it was when we first heard about it, you see on the WHO website, the first cases were reported like January 21st of this year. The dollar started to strengthen, the dollar index, precipitously, massively. The dollar strengthened almost to the level of 100, very significant levels on the dollar index. And then when coronavirus, and the reason for that, I should say, is because when you're choosing a safe haven, dollar, yen, or gold, you have to think, where in the world is the risky event happening? So it was happening in Asia when we first heard about coronavirus. And so the dollar was strengthening because the actual impact was physically located in Asia. Then coronavirus spread to other countries. It came to Europe, it came to the United States. And as the pandemic or the epidemic widened, U.S. equities decided to start to fall massively because it was a risk. We had those huge, 1,000-point drops in the Dow on those days. And so the U.S. dollar weakened. Now, where's the risk? Well, the risk was contained to Asia to start because of the virus. Now it's moved to U.S. financial markets because the Dow is down, the equities are down so heavily. So the U.S. dollar starts to weaken, and Japanese yen rotates in as investors' favorite safe haven currency at the time. So yen strengthens massively as U.S. equities are falling. And throughout this whole time, gold has been strengthening. Now there are structural underlying reasons for that, but gold is kind of like thinking for a currency trader, at least, because I was a currency trader my whole career. Gold we look at as like the safe haven of last resort. So I don't want to say it's the safest safe haven, but I feel like it's the safe haven of last resort. If everything is kind of going wrong everywhere in the world, an epidemic is spreading, global equity markets are falling, gold is the safe haven of last resort. So it's no wonder that it's been strengthening, and most likely will continue to do so as well.
Well, I think gold's an interesting market too because I think of it as an excuse market. What stimulates gold? It needs an excuse. Now, when Anthony was talking about supply and demand for crude oil, that's a very basic economic relationship that drives, one of the things that drives that market. But when it comes to gold, it is supposed to be that store of value, right? It's supposed to represent that, which is why money flows towards it. But it needs an excuse. It's not supply, it's demand, but it's the perception of uncertainty oftentimes. So when we see gold moving, is it moving on reality? Or is it moving on the perception of something that may happen in the future? What do we know now about this coronavirus? Will it end? China's seeing fewer cases, and they're seeing more people coming out of this better than they are seeing new cases. So we're seeing a transition there. Is this going to be forever? No. How long, how bad, who knows? But it's not forever. The issue is, can our stock market survive? And that's the other issue. You're talking about the central banks making changes. It's a piece of the puzzle, right? So when the central banks lower their rate, it makes easier for businesses to expand. That's the idea. It provides more money in circulation. That's the idea behind it. It can stimulate our economy. But here's something that it can't do that we want to remember. If I'm a bank and I have loans out there and this person can't meet their loan obligation because they lost production, this doesn't solve that issue. And what I found interesting is what the central bank did in China. What they did is they told their banks, look, if somebody misses a loan payment, do not penalize them. So they recognized the change in interest rates isn't the whole picture, that it does have other impacts in the economy. And when we think about what's happening with China, this production issue, there's two areas. One is producing assembled, completed product that people around the world buy, and the other one are components. It may be that 10-cent piece of a part that a company here in the United States needs to complete their project, and they are the only production source for it. We see it in rare earth elements. China controls 95% of that. And what those are first, they're not rare. They are elements that when we mine them, they're not the same as a silver vein that we extract the silver. It's blended within the earth. And we have a mine out in the West Coast that has been shut because China decreased the prices for these. But this is a critical area. They control 95% of it. Every electronic thing you have in this room now or at home is going to have a piece of this. Your lithium battery, for example. The other area that I'm concerned about is not only, and by the way, the Department of Defense went to the mine out in the West Coast that said, you guys used to mine rare earths, right? And they said, yeah, we used to. And they said, start it up. So the Department of Defense wants rare earths made in our country. Right now, we mine it and we send it to China to process. They want it done here. Our new fighter jets at F-35, there's a half a ton of rare earth elements in that. So I'm mentioning it because that challenge could surface when it comes to the stock market and the companies that produce things. You know, right now we've seen Apple and other countries say, you know something, maybe we're a little too dependent upon China. So let's go to Vietnam. Let's go to some other countries to produce our products. So we have other sources for production. Well, excuse me, it's not just us. It's not just U.S. companies. There are other countries that are contemplating the same thing. So demand in Vietnam, let's say, is going to be incredibly high. And if you want to shift production, which means assembly, that can be done fairly quickly. If you want to shift production, the manufacturing of parts, that's a different animal, and that's not going to happen overnight. So I think there's some things out there beyond the coronavirus that we want to be sensitive to. And what I find interesting is how the stock market absorbs this information. You know, as I mentioned, it hates uncertainty. This coronavirus is uncertainty. So it's going down. Logical. We're seeing the currency strengthen. Logical. Dollar's weaker, just as Amelia mentioned. Gold's up a bit. Crude oil's down. The supply-demand issue that Anthony mentioned. But what's interesting is how the stock indexes absorb this information. And from my point of view, what the CME group provides us with are choices. So you have the top ones would be the S&P 500, the NASDAQ, the Dow, and the Russell. But they really march to the different beat of different drums. You know, if you think about the NASDAQ market, it's considered a technology stock index because of how it's constructed. In other words, it doesn't have financial stocks in there. It doesn't have real estate stocks. It does not have utility stocks. 48% of the index are technology stocks. So that's why it's considered a technology stock. If you look at the Russell 2000, those are small to mid-cap companies. The international issue exposure is not the same as it is for the S&P 500. The S&P 500, 45% of its income comes from outside the United States. The Russell 2000 doesn't have that exposure. So yes, do they kind of move in a similar direction? Yes, but not the same rate of speed. One of the things I'm going to do tomorrow in a presentation I have on these stock indices is to look at how we can evaluate, how we can determine spreads. How do we determine if these indices are moving together or in opposite ways? How do we decide if the timing of this movement is right on target or if it's offset? That maybe one leads another. Does the Russell lead the other indices. It does have a tendency to do that. So there's some basic tools, percent change charts, that you and I can use to help us identify those changes and some spread opportunities. Last point here is that something I also find interesting, that, and you probably have seen it too, is, last May, the CME group started a new product, the micro stock indices. Does anybody trade those?
I do.
Yeah, some people do. Yeah,
I do.
It's a very friendly product in terms of the cost for us to put positions on. If you're in equity, how many people here trade futures? Okay, about a third maybe. If you haven't traded futures, a place you may want to consider beginning may be these micro contracts. They have them for metals, they have them for currencies, and they have them for the stock indices.
They're going to introduce energy also.
Yeah, that's right. They have a mini contract right now, but that really wasn't a solution. I think
Right,
that micro
exactly.
there is going to be a very logical. So now you can participate at this lower cost. Your margin cost from $7,500 for an S&P now is $750 for a micro. So your ability to initiate a position, hold a position, is interesting. And you know something else that we're also seeing regarding the micros is that people are using them instead of options.
Yeah.
And one of the things we're going to look at tomorrow in the 5 deadliest option mistakes is the name of the presentation, thank you, is how you and I can use micros in place of options. So it's an amazing, interesting time. But I think it is a time for us all to be okay. I mean, if you need your money today, you may have had a hit in your accounts. If you're going to need your money 5 years from now, 10 years from now, does today really matter? If you think about it from a longer term point of view, and these markets that we've covered, the currencies are such an interesting barometer of what's happening. And Amelia, you really touched on some ones that, the Australian dollar, Canadian dollar, Japanese yen.
CME futures, E-mini and micro for all of these products that we're talking about. And I think it's interesting with currencies. We always talk about trades, because we have to. They say the same thing on financial media, one trade at a time, because you have to discuss a trade and debate a trade. But in reality, as a portfolio manager or as a trader, especially at a hedge fund, especially at a bank, you're going to have a series of trades on together, not just this one trade. And so you have to think about sizing. And I think the contracts for CME futures, certainly in FX, that's what I do, can help with that. So you have an idea, or you have something that's happening right now, China, Australia dollar, demand falling. That could be, you could size that with a CME contract larger, and you have something else rotating in the back, another idea. But it's not happening right now. You can start to have that position on in a smaller size, and these micro and mini contracts with the CME allow you to do that in an easy way, I think, easier way to size your conviction in a trade.
I think you're right. It does give you that flexibility, and that's one of the ways to think about those microcurrencies. And I think it's going to be interesting, Anthony, as this micro crude oil comes out. Crude oil is such a unique product. And the product that we trade here really is a barometer for what's happening in the world, as you were mentioning, Anthony. It's something that you and I always want to be aware of. One thing I would just mention quickly is that there are other ways to get exposure to crude oil. One of them is to trade ETFs. But what you want to keep in mind is the dynamics of an ETF, of how it moves compared to what we see in the futures market, don't always match up. If you look at USO, for example, that ETF, 48% of it are futures, but the rest are swaps and other instruments. That does not necessarily mirror what we see in the crude oil market. And it's going to be interesting, Anthony, to see this demand situation that you're talking
Absolutely.
about.
I mean, during these last few weeks, I've actually gone away from trading outright crude oil to doing more of spreads, the front month of cracks or another thing that I look at, something to hedge myself. Right now in crude, we've got a bit of a contango going in the market, and I would imagine that's going to get deeper right now.
Do me a favor. Explain contango and backwardation.
Right.
Those ideas.
Well, normal backwardation is that the front month of crude oil would be higher than the back, or price would be higher than the back months. And that's normal because demand it would be strong, things like that, or normal demand. You would pay more for something now than you would a month from now. What's going on now with contango is because demand is dropping crude oil, you have the front month cheaper than the back months because right now, at this point, there's a question over whether demand is going to be good. So do you want to own that front month rather than the back month? So this is what we're getting. I expect that to go deeper than where it is right now. So that's another thing. You sell that front month, start buying the back months of crude oil. Or the cracks are another thing, which is basically tells you a barrel of crude oil, what a refiner makes out of that barrel of crude oil. That's what the crack is. Usually they're pretty strong at this time of the year because we're ramping up for summer demand.
Give them that, well, not necessarily the ratio, but give them, we're taking crude oil, we're breaking it down into its components, right?
Right, exactly. Well, I mean, it's funny how it works, but crude oil is priced in barrels and the products are priced in gallons. So that's where the crack comes in. You have to do a formula. It's take the price of the product times it by 0.42 because there are 42 gallons in a barrel, and that's the price of your crack right there. Subtract the crude oil, you get the price of the crack. So right there, there are a lot of ways to look at these markets to trade them. You don't have to be outright short, long crude oil or gasoline or things like that. You can hedge yourself.
Yeah, this crack spread he's referring to, you also want to think about it in terms of if you were going to buy crude oil and break it down into gasoline and jet fuel. You break it down into its components. So if you think about what would be your challenges that you're concerned about pricing, you're concerned that you're going to pay more for the crude oil than you can sell those components that you make. And the issue is then when it comes to hedging, which is one of the ways this is used, and we could hedge with currencies, and anytime we touch another currency, hedging is a tool we could use. And the hedging is, if you think about the oil producer, all right, they're going to buy crude oil. So what do they care about? They care about prices increasing for them. So if they're going to buy in the future, they're going to buy futures to hedge that. On the other side, they're getting these products out that Anthony referred to, and they're going to sell those products. So what are they concerned about? They're not increasing prices, but decreasing prices. So there they would sell futures to protect themselves against decreasing prices. So there's a variety of spreads. That's what's so interesting about crude oil.